Fannie Mae and Freddie Mac, the two entities that stand behind the overwhelming majority of conventional mortgages in this country, have rewritten how condo projects get approved for financing. The headline number is this: the standard minimum allocation for replacement reserves is going from 10% of an association's annual budgeted income to 15%, effective January 4th, 2027. An association either hits that 15% or it produces a current reserve study done within the last 3 years, documenting that it's funding at the highest recommended level. They also eliminated what was called baseline funding, which had let reserve balances drift towards zero as long as the paperwork looked right. Second change, the shortcuts are gone. Fannie's limited review and Freddie's streamlined review, the fast paths that let a well-qualified buyer with a big down payment skip the deep project examination, are being retired. Any community with 11 or more units now goes through full review, regardless of how much the buyer puts down. Projects with 5 to 10 units can get a waiver, but only if they're not part of a master association, not multi-phase, properly insured, and not already flagged as unavailable in Fannie Mae's Condo project manager system. Third, insurance. As of July 1st, 2026, the maximum allowable per unit deductible on a master property policy is capped at $50,000. Deductibles above that require unit owners to carry supplemental HO6 policies. There's a partial offset here. Roof losses can now be settled at actual cash value instead of full replacement cost, which lowers premiums, but the deductible cap is the binding constraint for a lot of buildings. I'll flag that some of the effective dates are reported slightly differently across sources, so verify the exact calendar for your building. The reserve requirement date, January 4th, 2027, is consistent everywhere. Why this is a bigger deal than it sounds: here's the mechanism, and it's brutal in its simplicity. If a condo project doesn't meet the standard, it goes on what the industry calls the ineligible list. Fannie Mae maintains it. Once your building is on it, conventional financing for units in that building gets denied. Think about what that means for a seller. Your buyer pool instantly shrinks to cash buyers, portfolio lenders willing to hold a loan on their own books, and nobody else. In a normal market, conventional financing is how most people buy. Remove it, and you haven't made your condo worth 10% less. You've made it worth whatever the small number of cash buyers in your price range decide to pay. That's not a price adjustment. That's a liquidity event. Estimates of the exposure run to hundreds of buildings and as many as tens of thousands of units nationally. Joel Berner, an economist at Realtor.com, put the core problem plainly. The additional reserve requirement might be especially difficult for associations to make up, since they'd likely budgeted for 10% of their budget in cash holdings and are now required to hold 15%. That's the whole squeeze in one sentence. An association that was compliant last year, that did nothing wrong, that has a functioning board and a reasonable budget, can become non-compliant purely because the bar moved. And there's a real debate about whether this is the right trade. Taylor Stork of the Community Home, Lenders of America, asked the question directly: are we solving for risk or unintentionally increasing expense in aggregate? Both readings have merit. After Surfside, nobody wants to defend underfunded reserves in aging towers. That's how buildings fail and people die. But there's a difference between requiring buildings to be safe and requiring them to hold cash at a level that forces dues up for people on fixed incomes. The rule doesn't distinguish between a tower with structural problems and a well-maintained building that simply budgeted conservatively. Where this came from, it's worth understanding why the rules changed, because it explains why they're unlikely to be softened. In June 2021, Champlain Towers South collapsed in Surfside, Florida, killing 98 people. The building had documented structural deterioration and an association that had spent years arguing about whether to fund the repairs. The investigation that followed made a very uncomfortable thing visible. A condo association can vote, repeatedly and legally, to defer maintenance that keeps the building standing, because every board member is also an owner who pays the dues. That's a structural conflict of interest baked into how condominiums work. Boards are made of people who personally pay for whatever they approve. Deferring is always the cheaper decision this year, and the bill lands on whoever owns the unit when it finally comes due. Fannie and Freddie's response was to stop lending into buildings that do it. If an association won't fund its own reserves, the agencies won't stand behind mortgages there, which turns a maintenance decision into a property value decision and gets owners' attention in a way that a board meeting never did.